Accounting for taxes is a necessary survival skill for any entrepreneur in Uganda. If you don't know how to calculate what you owe the URA, you can't accurately plan your budget or set your prices, and that leads to costly penalties. But there is a common misunderstanding about how personal income tax, or PAYE, actually works. Many people assume the government takes a flat percentage of your entire paycheck. That isn't true. Uganda uses a progressive tax system. This chart shows exactly how it works. Think of it like a staircase. As your income rises, you step up into higher tax brackets, but you only pay the higher rate on the specific portion of money that lands on that step. The money on the lower steps stays at the lower rates. This structure protects low-income earners. The lowest step is entirely tax-free. So even if you earn enough to reach the top 30% bracket, your first block of income is completely untouched. Moving into a higher bracket only ever increases the tax on your extra income. Let's see how this math plays out for an employer in Kampala. Say you have an employee earning 500,000 shillings a month. Because tax bands are annual, the very first step is to multiply that monthly salary by 12. That gives us a total taxable annual income of 6 million shillings. Now, we pour that 6 million into our tax buckets. The rule says the first 2,820,000 shillings is completely tax-free. That fills the bottom bucket, and the tax generated here is 0. We have money left over, so we move to the next bracket, which taxes income between 2,820,000 and 4,020,000 at 10%. That 1,200,000 shilling chunk generates exactly 120,000 shillings in tax. We keep going. The third bucket taxes income up to 4,920,000 at 20%. Taking the difference between those two limits gives us another 900,000 shillings of income. 20% of that is 180,000 shillings. Finally, we place the remaining 1,080,000 shillings in the top 30% bracket. This chunk generates 324,000 shillings. To find the total annual PAY, we just add the tax from all buckets together, giving us 624,000 shillings. If you pay a salary, you are legally responsible as the employer to perform this exact calculation. Deducting the correct tax before the money reaches the employee ensures you stay compliant, without accidentally shortchanging your staff's net pay. Try it yourself. Pause the video and calculate the annual tax for an income of 4.5 million shillings. Using the same bands, the first bracket is 0, the second is 120,000, and 20% of the remaining 480,000 gives us 96,000. The total is 216,000 shillings. While PAY applies to employees, small business owners face a completely different calculation. The URA recognizes that a neighborhood hardware shop doesn't have the sophisticated accounting systems of a formal multinational corporation. To accommodate this, the government offers the presumptive tax regime. This is a simplified system designed specifically for businesses generating less than 150 million shillings in annual sales. The logic here relies on the strict difference between profit and turnover. Tracking net profit requires meticulously recording every single business expense. Presumptive tax skips that step. Instead, it is calculated based solely on your total incoming sales, or turnover. The URA simply presumes a certain profit margin based on your sales volume. By removing the need to build a complex balance sheet, this system makes it affordable and straightforward for small traders to meet their tax obligations. Let's review the core distinction in this table. For PAYE, the base of calculation is an employee's gross salary, filtered through progressive bands. For presumptive tax, the base is strictly the small business's annual turnover. Today, you rarely have to do these calculations by hand. The Electronic Fiscal Receipting and Invoicing Solution, or EFRIS, automates the computation process. When you issue a receipt through the system, the specific tax owed is calculated in real time. With the math handled automatically, your primary responsibility shifts. The focus is no longer on mastering the manual formulas, but on strictly entering accurate sales data. If you type in the wrong amount, EFRIS computes the wrong tax, leading to automatic audits. By understanding exactly how these underlying figures are calculated, you can treat your taxes as a predictable cost of doing business rather than a sudden threat to your cash flow. Keep practicing these models and explore the Yaka Digital Network platform for more tools to build a compliant, profitable enterprise.